Hello again, it's David Sime here with Business Class Group Croatia. If you see my first video, welcome back. If you're new here, this is visokiprinos.com, your gateway to institutional grade structured investment notes available to Croatian residents. I'm back today because the product range has been updated. We have new issues, higher coupons, and most significantly, two products I want to explain in detail because they work very differently from each other. The product range now includes 8 global investment banks. 3 names are new since my last video: BNP Paribas, Santander, and Mirex Financial. The maximum annual coupon has moved up to 40%, and we now carry products ranging from fully capital protected product structures where you simply cannot lose what you put in, all the way to high yield speculative notes for investors comfortable with more risk. So let's start with the most conservative of the two products that I want to highlight today, the BNP Paribas Capital Protected Note. This is the one to understand if protecting your capital is your primary concern. Here's how it works, and I promise you it's simpler than it sounds. You invest a fixed amount of US dollars, let's say $100,000. The money is placed into a structured note issued by BNP Paribas, one of the world's largest banks. The note is linked to the S&P 500. That's the index of the 500 biggest companies in America: Google, Apple, Amazon, you know these names. Over the next 6 years, BNP Paribas pays you a quarterly coupon based on how the S&P 500 performs. And here's the critical part. Your original capital, the $100,000, is 100% protected at maturity, completely. If the S&P collapses by 50%, you still get your 100,000 back. If it goes nowhere, you still get your 100,000 back. If the S&P 500 rises, and historically it tends to do so over a 6-year horizon, you participate in 113% of that gain. Not 100%, 113. You actually get more than the index return. This is the BNP Paribas 113% participation note. The absolute worst case is you receive exactly what you put in, the capital protection in its purest form. Now, I want to talk about the other end of the spectrum, a product that offers significantly higher returns, but with correspondingly higher risk. This is not suitable for every investor, just the more experienced investor. The Société Générale technology sector note offers 40% per annum. That is 10% every quarter. It runs for 4 years and is denominated in British pounds. The underlying stocks are 4 of the most recognizable technology companies in the world: Oracle, Tesla, Intel, and Nvidia. For the coupon to be paid each quarter, all 4 of those stocks must remain above 50% of the price they were at when the note was struck. Not one of them, all of them. Every single one must stay above 50% barrier. So imagine this: Oracle is up, Nvidia is up strongly, Intel is flat, but Tesla has fallen to 45% of the start price. In that scenario, no coupon was paid for that quarter. And at maturity, if anyone's stock is below the 50% barrier, you do not get your full capital back. Your loss would reflect the performance of whichever stock performed the worst. This is the trade-off. The reward for accepting that risk is 40% per year, potentially very significant. But this product is designed for investors who understand the underlying companies, can tolerate the risk of a single stock volatility, and are comfortable with the possibility of capital loss. So you can see, even within a single asset class, structured notes offer a remarkable risk and return profiles. At one end, a capital protected note, where the worst outcome is getting exactly your money back, with market upside beyond that. At the other end, a high yield 4-stock note that can deliver extraordinary returns for the right investor, but with risk to capital. My job is to match you with the right product for your circumstances. That conversation starts at visokiprinos.com.